Welcome to the deep dive.
Great to be here.
Today we're really digging into something specific, the corporate mobility market in India.
Yeah, it's a fascinating space. We've got this Frost and Sullivan report updated just this August.
Right, the analysis of corporate mobility market in India and also some thoughts from Avis India.
Exactly. About, why chauffeur services are still so important for businesses.
So our mission today.
Well, it's really to pull out the key insights, especially for anyone watching emerging markets looking for opportunities.
We'll look at where things stand now, where they might be heading.
And crucially, who the main players are in this, well, pretty dynamic sector.
The big question, I guess, is this market ready for maybe more disruption, and where are the real opportunities?
That's what we're hoping to shed some light on today.
Okay, so let's start with the big picture, India's economy, because that really sets the stage, doesn't it?
Absolutely.
Yeah.
You can't look at this in isolation.
Yeah.
That Frost and Sullivan report, it points to pretty strong GDP growth.
Something like 6.5% annually, projected right up to 2030.
Yeah, exactly. And that puts India on track to potentially be the third largest economy globally?
That's huge. But it's not just the overall GDP, is it?
No, and this is a key point, I think. It's also the rising GDP per capita.
Right.
The report expects a compound annual growth rate, CAGR, of about 9.4% there between FY 2025 and 2030.
So basically, people having more money to spend, on average.
Precisely. And that naturally changes how people think about transport, both for themselves and for work.
Makes sense. And then there's urbanization, more people moving to cities.
A massive factor. They're projecting over 40% of the population in urban areas by 2030.
Which is, what was the number? Around 625 million people.
Yeah, something like that. And when you have that density, you absolutely need efficient ways for people to get around.
Right. Personal cars for everyone just doesn't scale in that scenario.
Not at all. It drives demand for shared mobility, for better public transport, and definitely for corporate solutions too.
And it's not just the big megacities, is it? The report mentioned growth in the working population everywhere.
Both rural and urban areas. So
Yeah.
the overall need for mobility is just increasing across the board.
Now, this bit I found really interesting. The rise of the Tier 2 and Tier 3 cities.
Oh, definitely. That's a critical trend to watch.
They're becoming real economic hubs.
Yeah, driven by government schemes like UIDF, support for smaller businesses, MSMEs,
Better internet, companies actually moving operations there.
all of it. And it directly translates to needing corporate transport services in those cities, not just Mumbai or Delhi anymore.
The report even broke down startup activity there. IT services, healthcare, education.
Yeah, it shows real economic diversification happening.
So these smaller cities are a major growth area for corporate mobility providers.
Without a doubt. It's a different market, maybe different price points, different needs compared to the big metros, but huge potential.
And you layer on top of that the general expansion of road transport. What was it, 8.2% CAGR expected?
Right. And the booming services sector overall. That's another huge driver.
Nearly 10% CAGR projected there, plus these global capability centers, the GCCs.
Expected to almost double by 2030, right, reaching around 2,400.
These are businesses that heavily rely on getting employees to and from work reliably.
Exactly. And just the sheer number of active companies in India keeps going up. That benefits the on-demand side. Mobility as a service.
So lots of underlying economic factors pushing this market forward.
And you've also got the government focus, in the budget on infrastructure, sustainable transport, EV adoption. It's all pointing in the same direction.
Okay, so let's zoom in a bit. The light vehicle mobility market itself, how does it break down?
So as of 2023, the report splits it. You've got personal vehicles and then the cab segment.
And that cab segment's pretty big.
Yeah, $21.5 billion. And it's split almost evenly, interestingly.
Between.
Retail mobility, that's your B2C, like ride-hailing for individuals, at $10.7 billion.
Okay.
And corporate mobility, the B2B side, we're focusing on slightly larger at $10.8 billion.
Got it. So that corporate piece, the B2B, almost $11 billion in 2023. How does that break down further?
Two main parts. There's employee transportation services, ETS. That's the bigger slice.
Getting employees to work and back.
Right. That was about $6.1 billion.
And the rest.
That's corporate car rental, CCR. Things like airport transfers, client meetings, events. That was around $4.7 billion.
Okay, so ETS is the larger chunk, but CCR is still very significant.
Definitely. Both are substantial markets on their own.
So let's dive into that corporate market growth. What's fueling it specifically? Return to office is one factor mentioned.
Yeah, that's a big one. As more companies mandate office work, even hybrid, the need for reliable commutes spikes.
And the focus on employees, satisfaction, safety.
Absolutely. Companies are seeing good, safe transport as part of the employee value proposition now. It's not just a logistical necessity.
Plus more corporate travel generally, air travel, airport expansions.
Uh-huh. And as Indian companies grow internationally, their travel needs increase.
Technology adoption must play a role too, making things more efficient.
For sure, better booking platforms, tracking, reporting. It makes managing corporate mobility easier.
And just more office space being built, especially in IT.
Yeah, more offices mean more people needing transport. It's quite direct.
Now, you mentioned premiumization earlier in the context of the overall car market. Is that hitting corporate mobility too?
Very much so, according to the report. There's a clear shift.
Away from just basic economy cars?
Exactly. Increased reliance on chauffeured rentals and companies actively looking for alternatives to the standard ride-hailing apps.
Why? What are they looking for?
Dependability, mainly. Consistent service. Transparent costs.
Huh.
Not just the cheapest ride available at that moment.
The numbers back that up.
Yeah, pretty starkly.
Mm-hmm.
Economy car share dropped significantly from nearly 80% in 2018 down to about 62% in 2023.
And premium.
Grew from under 19% to almost 36% in the same period.
Wow. Okay, so quality and reliability are becoming much more important than just price for corporates.
It certainly seems that way. It suggests value as a key differentiator now.
Let's talk revenue forecasts. The numbers look pretty healthy. ETS first.
Estimated at over 500 billion rupees, that's $6.1 billion US in 2023.
And projected to.
More than double by 2030, reaching nearly 1.1 trillion rupees or $13.2 billion US. That's a CAGR of 11.8%.
Pretty strong growth. And corporate car rental, CCR.
Also growing well. Estimated around 392 billion rupees, $4.7 billion in 2023.
Projected.
To hit about 732 billion rupees or $8.8 billion by 2030. That's a 9.3% CAGR.
Still very solid.
Yeah.
And how is that CCR market used? Is it mostly just regular business travel?
Mostly, yes. Corporate travel accounted for about 75% in 2023.
But not entirely.
No, you also had significant chunks for event-based corporate needs, maybe 10%. Corporate conventions around 6%.
Okay.
And even sports and government events making up about 5%. So it's quite varied.
Now, this shift you mentioned earlier, from unorganized to organized players, can you unpack that a bit?
Yeah, this is a really important dynamic in the Indian market.
So unorganized means, like, smaller local taxi operators.
Pretty much. Individual owners, small companies, maybe operating just in one city, often without much technology or standardized processes.
And the organized players.
These are the larger companies, often with a national presence, integrated technology platforms, proper safety protocols, service-level agreements. And the trend is clearly moving towards them.
Why? What's driving corporations to prefer organized providers?
It comes back to reliability and accountability. Corporates need partners they can depend on everywhere they operate.
Pan-India presence is key then.
Yeah, and operational efficiency that comes with tech. And crucially, safety standards. Organized players are just better equipped to deliver on those consistently.
What's the market share split now, roughly?
In 2023, organized ETS was maybe around 15%, expected to grow to about 18% by 2030.
Still relatively small, but growing.
Yeah, CCR has a higher organized share, maybe 25% in 2023, projected to exceed 30% by 2030.
So still a lot of the market is fragmented, but the organized segment is gaining ground.
Definitely. The formalization is happening.
And technology is evolving alongside this. We're seeing specific platforms for managing corporate mobility.
Yes. End-to-end solutions are emerging.
The report flags some concerns.
Yeah, mainly around robust checking systems, maker-checker processes, basically ensuring checks and balances.
To prevent errors or fraud.
Right. And data privacy is always a big concern when you're handling employee travel data.
So providers are trying to address this.
Yes, more secure, comprehensive solutions.
Okay. Just quickly, for context, the retail side, ride-hailing is still the biggest piece there.
By far, $6.6 billion in 2023, though its growth is projected to be slower, around 3.2% CAGR.
And retail car rental.
About $4.1 billion, growing faster at 9.2% CAGR.
And self-drive. Still small, but growing rapidly.
Very much so. Only $0.1 billion in 2023, but projected at over 22% CAGR. It's nascent, but attracting interest.
And booking behavior is different.
Totally. Car rentals, whether retail or self-drive, are mostly pre-scheduled, like 95%.
Whereas ride-hailing.
Almost all on demand. 95% on demand. Different needs, different models.
Right. Now, looking globally, how does India sit in?
Well, the global corporate mobility market is also growing nicely, projected 9.6% CAGR overall.
CCR growing faster globally than ETS.
A bit, yeah. CCR projected at 10.4% CAGR globally, ETS at 8.2%.
But India is leading the pack.
That's what the report suggests. India's overall corporate mobility growth is projected at 10.7% CAGR, outpacing the global average.
That's significant. And there's this other statistic about vehicle availability.
Ah, yeah, that was quite striking. It compares the number of employees per corporate mobility vehicle.
And India has a lot more employees per vehicle.
Way more. 546 employees per vehicle in India. Compare that to China at 372.
Okay.
The U.S. at just 36, and Europe down at 10 employees per vehicle.
Wow. So that suggests just huge untapped potential in India.
Absolutely. It points to a market that's historically been underserved compared to developed economies, leaving massive room for growth as companies formalize and prioritize mobility.
Why do you think that gap is so large? Is it just cost?
It's likely a mix of things. Cost sensitivity is definitely part of it in a developing economy.
Yeah.
Maybe different cultural views on company cars versus personal vehicles.
Infrastructure maybe played a role in the past?
Could be. Less developed road networks historically, though that's changing fast. But yeah, that gap screams opportunity.
So looking ahead, what are the main risks and restraints?
Well, that fragmentation we talked about is a risk. Makes it complex.
Operational challenges too.
Yeah.
Managing fleets, drivers, regulations.
Always. Fleet management is complex. Driver availability, training, retention, those are ongoing hurdles.
But on the flip side, the opportunities seem pretty significant.
They do. Tier 2 and 3 city expansion is huge. They expect, what, 57% of the urban workforce to be there by 2028? Plus, Indian companies expanding globally, needing seamless travel, more tech adoption for efficiency.
The growth in GCCs we mentioned?
Yep. Better airport connectivity, improving road networks.
And business travel bouncing back strongly.
Expected to be pre-COVID levels by 20% by 2027, apparently. And the general formalization of the sector, all positive drivers.
And what factors will make or break players in this market?
Safety is paramount. Consistent maintenance, cost effectiveness, of course, and increasingly smart tech integration and customization.
Okay, let's touch on those case studies. The app-based guys, Ola, Uber, successful in retail but struggling in corporate.
Yeah, the report outlines several challenges they face trying to pivot to B2B.
But why is it so hard? Their tech works, people use them.
It's different. First, branding. They're seen as B2C. Second, they compete directly with established ETS players who only do corporate.
Okay.
They also need different systems, sophisticated fleet management systems, or FMS. That's investment.
And driver issues, liability, incentives.
Big ones. Remember those driver protests over incentives back since 2018? Corporations worry about that kind of instability and liability.
And the service itself might not meet corporate standards.
That's a key point. Corporates need guarantees on vehicle quality, maintenance, hygiene, professionalism of the driver, fewer cancellations.
Stuff that's maybe more variable on the retail side.
Exactly. And they need customized solutions, reporting, compliance, things the aggregator model isn't inherently built for. It's a tough fit.
Then you have the aegis perspective. Chauffeur-driven is still essential.
Yeah, they make the case for productivity, especially for, say, multiple meetings across a city.
Like navigating Bangalore traffic? You're not working if you're driving yourself.
Right. You arrive stressed, tired. With a chauffeur, you can relax, prepare, make calls, arrive, ready to go. It's about optimizing executive time.
Makes sense. Now, the big topic, EVs, electrification, advantages.
Obvious one is sustainability, meeting environmental goals. That's increasingly important for corporate image.
Government incentives, too, potentially, though those schemes change.
Yeah, FAME ended, EMPS is temporary, but generally there's been a push. And EV tech is getting better all the time.
But big disadvantages, too, right now.
Definitely. High upfront cost is still a major barrier, both for the vehicles and the charging infrastructure.
You need chargers at depots, maybe even employee homes.
Right. Then there's TCO, total cost of ownership. It's still a bit uncertain. We saw Hertz selling off EVs partly due to unexpected depreciation and repair costs.
Operational hurdles, too. Charging time, range anxiety.
Yeah, planning routes and schedules around charging takes effort. Maintenance requires different skills.
Battery issues, degradation, resale value.
All concerns. Plus, regulatory changes, grid capacity, even just getting employees comfortable with EVs. Lots of complexities.
And broader market constraints.
Still not enough public charging, especially outside big cities. Charger compatibility isn't always standard. Lack of skilled EV technicians.
Battery tech limitations, recycling questions.
Supply chains for raw materials, it's improving, but these are real constraints holding back mass corporate adoption right now.
So promising, but challenges remain.
That sums it up well.
Okay, so for someone tracking this market, does that dominance suggest high barriers to entry, or is there room for smaller players?
That's a good question. Scale clearly matters here for efficiency, reach, negotiating power.
But
But the market is still fragmented and growing. There could be space for niche players, maybe focusing on a specific industry or a region or offering unique tech solutions.
especially with that shift to organized players' reliability and tech matter, maybe more than just size.
Could be. If a smaller player can nail reliability, safety, and tech integration, they could definitely carve out a space.
The report also benchmarks them financially. Revenue, profit margins, debt.
Yeah, for the listed ones. Looking at things like EBITDA margins, debt-to-equity ratios, return on capital.
And eco-mobility looks strong there too. High efficiency, low debt.
Relatively, yes.
Yeah.
High fixed asset turnover, which suggests they use their assets efficiently, likely helped by an asset-light model, not owning all vehicles.
And healthy profit margins. EBITDA, PBT.
Yeah, indicating good operational profitability. Strong ROCE and ROE suggest good returns on the capital invested in the business.
Okay, so wrapping this up, what are the main takeaways from our deep dive?
Well, first, the Indian corporate mobility market is definitely a high-growth area. Strong economic drivers behind it.
Urbanization, formalization of business.
Right. Second, while it's still fragmented, the shift towards organized, tech-enabled players is undeniable. Reliability and safety are key drivers there.
NEVs.
Huge potential, aligns with sustainability goals, but facing real practical and cost hurdles for now. It's an evolution, not a revolution yet in this specific sector.
Okay. So a final thought for our listeners to chew on.
Yeah, I mean, considering how unique India's market is, with those tier 2 and 3 cities booming, and the specific needs of companies here, how might really innovative, maybe tech-first solutions further shake things up? How can they tackle those constraints, especially outside the metros, and smooth the path to greener options?
Are there completely new business models waiting to emerge beyond just ETS and CCR as we know them today?
Exactly. What does the next generation of corporate mobility look like in India? It's definitely a space worth watching very closely.
Absolutely. Lots to think about there.